treasury stock transaction problem. On January 1st, Lorraine Corporation had 2,000 shares of $5 par common stock authorized and outstanding. These shares were originally issued at a price of $26 per share. In addition, 500 shares of $50 par preferred stock were outstanding. These were issued at a price of $75 per share. During the year, the following stock transactions occurred. March 3rd, Lorraine reacquired 100 shares of its own common stock at a cost of $24. April 27th, it sold 25 shares of the common stock acquired on March 3rd for $33. July 10th, we sold 25 of those shares for $22. And October 12th, we retired the remaining shares acquired on March 3rd. Prepare the journal entries to record the treasury stock transactions of Lorraine, assuming it uses the cost method. So we'll start out with March 3rd, and we're reacquiring 100 shares at a cost of $24. So we're going to debit our treasury stock and credit cash, and that's going to be for the 100 shares at $24. And let me go ahead and make these number formatted. I'm also going to create T accounts over here on the side for our treasury stock so that we can just keep track of this. It's one of those things that I would say is really important, especially for treasury stock transactions, because we start selling the shares that we've purchased. And so if in this problem it's short enough that you really don't have to have this, but it gets confusing in a bigger problem or more like a real life sort of situation. So I'm going to put the 2400 here, but on the side I'm going to note 100 at 24. So then on April 27th, we sold 25 shares of common stock acquired from March 3rd for $33 per share. So we sold it for more than we purchased it back from. So we're receiving cash and we're getting rid of treasury stock, so we have to credit treasury stock. But because we're selling it for $33 when we originally purchased it for $24, we're going to have an additional paid in capital from treasury stock account as well that we need to credit. And so we have 25 at 33. And the treasury stock is going to be the 25 at 24. And so that gives us the difference of 225 in our additional paid in capital from treasury stock. So I'm going to create that T account here. All right, and then over in our treasury stock, this was 25 shares that we got rid of. And so now this is helpful because we can quickly see there's 75 shares that we purchased at $24 left. And so I'm going to put the 25 at 24, not because we sold them at 24, but because it was from the original 24 transaction. Then we have July 10th. We sold 25 shares of that common stock that we acquired on March 3rd for $22 per share. So this time it's for less than we purchased it from. And because we have this additional paid in capital account, we can pull it from here, that like loss in a sense. So we're going to debit cash, and we're also going to debit that additional paid in capital treasury stock, and we will still credit treasury stock like we did in the previous transaction. So cash is going to be 25 times the 22, The Treasury stock is going to be the 25 times the 24. And so then the difference is clearly 50, but we could say here the 25 times the $2 difference, the 24 to 22 gets us that difference of $50. And so we'll fill in over here on our T accounts just so that we can keep track of what we have going on. And this July 10th transaction is completed. I want to make a point that if we didn't have an additional paid-in Treasury stock transaction, this would have had to have come from retained earnings instead. So if we didn't have it, it would have been retained earnings, or if it would have been greater than the 225 balance, we would have recorded the 225 out of additional paid-in capital, and then any remainder from retained earnings. But that wasn't the case in this problem. I just wanted to point out what that would look like if it did happen. Then, October 12th, we retired the remaining shares acquired on March 3rd. So of these 100 shares, we've resold 50 of them, so that means there's 50 shares left that we're going to retire. And they're retiring, meaning that they're no longer going to be available in common stock or treasury stock. So we're going to debit common stock, debit additional paid-in capital to common stock, and then we'll credit treasury stock and the APIC for treasury stock. And so this debit to common stock is going to be at par, 5 times our 50 shares. The additional paid-in capital is going to be this original issue price of 26 minus our par, so 21 times 50. Then the treasury stock is going to be equal to our 50 shares times the 24. And the additional paid-in capital is going to be this 26 per share minus the 24. So we'll say 26 minus 24 times 50. And then we could update our treasury stock T account here with that 1200, and that should give us a 0 balance, which it does because 2400 minus 6 minus 6 minus 12 gives us a 0 balance. And so that's good. And then we can also update our APIC on treasury stock account.